Good afternoon, colleagues. Let's start from formatting set all the documents to my assistant. Tell us about the balance sheet, please.
You can send all the information to me on the computer. Also, if you have presentation, I can help with switching the slide. If you want, I can bring you copy.
Income statement shows financial information over a period of time. Balance sheet on the company of the it is simple. Let me show. You have to read them. Balance sheet follow this equation. Assets equals liabilities plus owns equity. It's that simple. Assets are what a company owns. Liabilities are what a company owns. Equity in the company is the worth. Assets include cash, accounts receivable, inventory, fixed asset like land and property. Liabilities include accounts payable and debts. Owns equity is the total of the value of the company. That sum of the assets should be equal of the sum liabilities plus of the sum owns equity.
Excuse me, but you have a problem.
What's that?
I was looking at this month's balance sheet. Our accounts payable show that our $15,000.
What is that a problem?
Will we only have $10,000 in the bank?
I see, we have to borrow some money to pay the difference.
Isn't it a bad idea to take on more debt?
No, our accounts receivable show $15,000. We can use that to pay some debt next month.
All the problems of the solution is everything clear.
Yes.
Then tell me about the cash flow statements.
Sometimes an income statement shows huge net income, but the cash flow statement shows negative cash flow. How can this be? Cash flow statement shows the inflow and outflow of cash. This includes revenues and expenses, cash distribution to owners, dividends paid to stockholders, and financing activities. When a sale is made, it often takes months for payment to arrive. A company may have generated $500,000 in sales, but only received $100,000 in payment. The income statement counts $500,000 in revenue, but cash flow statement records only cumulative cash, the $100,000 in proceeds.
Hey guys, you could talk for a second?
Sure. What's up?
Well, our income statement shows a net income of $200,000.
That sounds not right.
But the cash flow statement shows only $100,000 generated from sales.
Oh, well, the cash flow statement only counts cumulative cash, the actual cash we spent and received.
So, are you telling me that we haven't resolved some of the payments on our accounts receivable?
Exactly. But our accounts receivable should make up for it by next month.
Fine. Tell us what changed.
I will put the documents on the table below you. You can look at them while they tell you.
Between January and March, revenue hovered around $35,000. In April, cost of goods went up slightly. As a result, we increased prices and this has a negative effect on sales. In fact, revenue plummeted sharply to $20,000. From April to June, revenue stabilized and steadily increased, and in July, sales dropped dramatically from $28,000 to just 19. This was the result of a new competitor opening up across town. We recovered quickly in September, just before the busy season, and this was partly due to a sharp decline. In cost of goods, it allowed us to lower our prices, and from October through December, we experienced our usual seasonal increases.
How brings the sales report?
Sorry, has the sales report still short?
Yes, thank you. Oh, sales revenue really plummeted in April.
Yes, it did. I'm not sure why.
Well, I was mostly a result of price increases.
That makes sense, but why did sales increase so much from October to December?
Well, the holiday season.
Yes, but I've never seen sales go with high, but else schools.
It's probably due to make toy shop going out of business. They measure competition.
Fine, what is the meeting? I would like to learn about extracting information from financial records.
Good morning. Many employees complain about carbon crackers. We do cashless of records, but this had good reason. We need them to assess the health of the company. Here are some ways we interpret your records. Return on sales, net income deducted by revenue equals return on sales. Return on equity. Net income deducted by equity equals return on equity. Year-over-year growth rate. Profit 2011 deducted by growth 2010 equals year-over-year growth rate. This equation and other help us examine factors that it vary at our profits. Last year we had then profits. Because we had accurate records, we found on that it was due to uncollectible receivables.
Here, scientific research of profit.
Wonderful, thank you.
I'm curious, why do you have to keep such detailed records?
Because they help us assess the company's health. Why do you ask?
Well, it slows me down. I'd rather spend time saving than doing paperwork.
I know what you mean. It takes time to do paperwork, but it's worth it.
How so?
Accurate records help us see if anything is eating away at all profits.
Many thanks to everyone for their hard work. Let's finish our meeting up